Most people quit investing right before the money would have started doing the work for them. And here's what surprises people. They do not quit because they picked the wrong fund. They quit because compounding feels slow, and nobody ever explained why it feels slow or how long the slow part actually lasts. So they stare at a boring account for a few years, decide the whole thing is a scam, and walk away. They were not wrong about the feeling. They were wrong about what the feeling meant. Here is the truth almost nobody says out loud. Compounding does not feel slow because it is broken. It feels slow because you are the slow part. The math is patient. You are not. That mismatch is the whole problem. And in the gap between how fast the math works and how fast you want it to work, that is where people quietly sabotage themselves. So I built a simple rule to keep you from doing that. 3 numbers: 100, 7, and 1. Each one guards against a specific way people wreck their own returns, not a way to beat the market, a way to stop beating yourself. I'm Tom. This channel is about real personal finance, the kind that actually works for normal people, not the kind that gets you to click a thumbnail. No motivational fluff or fantasy returns. We just discuss what the math actually does over time. If that's what you want, hit subscribe. Start with the first number. It is the one that scares people out of the market before they reach the good part. The number is 100. That is roughly how many times, across an investing lifetime, the market drops enough to make you want to sell. Here is where that comes from. It is not a scare tactic. It is just history. The S&P 500 has a 10% drop about once a year on average. Since 1928, at least one 10% correction has shown up in 64% of all calendar years. Bigger drops, the 20% bear markets, arrive about every 3.5 years. The average bear market takes about 35% off the top and lasts around 9 months. Now do the arithmetic on a real investing life. Say you start at 30 and invest until 65, that is 35 years. In that window, history says you will sit through roughly 22 years that contain a double-digit drop and around 10 full bear markets. Add in all the smaller scares, the 5% slides, and the ugly headlines. Now you are looking at something like 100 separate moments where your gut screams sell. That is the number. 100 gut punches. And here's the whole point of it. Every single one of them will feel like the exception. Everyone will arrive wrapped in a reason. Maybe a war or a failing bank. Maybe a virus or a crash nobody saw coming. Your brain will not file it under normal. It will file it under this time is different. The 100 exists to tell you the truth in advance. These drops are not a system failing. They are the system working exactly as it always has. The market does not hand you 9 or 10% a year for being smart. It hands it to you for sitting still through about 100 storms that made everyone around you panic. So when the next one comes, and it will, you do not need a genius move. You need to recognize it as number 37 of 100 and do nothing. Doing nothing is the skill. The 100 is there to make doing nothing feel normal instead of reckless. Here is why your brain fights you on this. Losing money hurts about twice as much as gaining the same amount feels good. That is not weakness, it is wiring. So when your account drops 20%, that pain lands about twice as hard as the matching gain ever felt. And it arrives all at once. Your body treats a market drop like a threat, and a threat demands action. Selling feels like doing something. Sitting still feels like standing in a fire and refusing to move. The 100 is the antidote to that feeling. It reframes the fire as weather. It turns a threat into a forecast. You do not run out of your house every time it rains. You have seen rain 100 times and you know it passes. But nobody ever showed you the truth about market storms. They pass the same way on roughly the same schedule. Once you have the number, the panic loses its grip. The drop stops being a catastrophe and becomes an appointment you already knew was coming. Think about March of 2020 for a second. In about 5 weeks, the market fell 34%. It felt like the end of the world, and plenty of people sold at the bottom to make the pain stop. By the end of that same year, the market was at a new high. The people who sold locked in the loss. The people who recognized it as one of the 100 and did nothing were made whole, and then some within months. Same crash. 2 completely different outcomes, decided entirely by whether the hands move. Which brings us to the second number, because surviving the drops only matters if you stay long enough to collect the reward. The number is 7. 7 years is roughly how long it takes before compounding stops being a rumor and starts being something you can see in your own account. Before that, it hides. After that, it shows up. Watch the real math. Say you put $500 a month into a broad index fund and you earn about 7% a year after inflation. Watch where the growth comes from. After 1 year, you have about $6,200. You put in $6,000 of that. Compounding added $196. Almost nothing. This is the part that makes people quit. After 5 years, you have about $35,800. You contributed $30,000. Compounding chipped in around $5,800. Better, but still not thrilling. Now year 7. You have about $54,000, and roughly $12,000 of that is growth you did not lift a finger for. Something has shifted. The account is starting to move on its own. Keep going and it gets loud. By year 10, compounding has added about $26,000. Year 15, about $68,000. Then year 20, you put in $120,000 over all those years, and compounding added $140,000 on top. The market is now contributing more than you are. Look at what happened across that timeline. In year 1, your money did basically none of the work. By year 20, your money did more of the work than you did. Nothing about the strategy changed. Only time changed. That is the entire trick, and there is no version of it that skips the slow beginning. I've covered the deep mechanics of that turning point in another video, so I will not rebuild the whole thing here. The one thing to carry with you is this. 7 years is the down payment. Compounding is not slow. It is just backloaded, and the bill for the big years comes due at the front. And here's why the 7 matters as a rule and not just a fact. The odds reward the wait. Over history, a single year in the S&P has been positive about 3/4 of the time. Hold 3 years, and it climbs to around 85%. Hold 10 years, and you are near 96%. Stretch to 20 years, and every rolling 20-year window in the modern record has been positive. Not most. All of them. Time does not just grow the money, it bends the odds in your favor. So the 7 is your defense against the quiet killer, the one that gets more people than any crash. Boredom. Most people do not sell in a panic. They just drift away during the flat years, convinced nothing is happening, right before the part where everything happens. Picture the person who starts strong at 30. They save hard for 4 years. They check the account, see the growth is still small, and a thought creeps in. Is this even working? A friend mentions a hot stock. Their own boring fund looks like it is crawling, so they stop the contributions or they cash out to chase something shinier. They were standing at year 4 of a 7-year climb, one step from the ground starting to tilt in their favor. And they walked off the trail because the view had not changed yet. That is the tragedy the 7 is built to prevent. The flat years are not a sign the plan is broken. They are the plan. The base is being poured, quietly, under the surface. You cannot watch concrete cure. But if you dig it up every week to check, it never sets. The 7 tells you how long to leave it buried before you were allowed to expect the vertical part. Now the third number. And this is the one I most want you to remember because it is the one that actually decides how rich you end up. The number is 1. Not 1 year, not 1%, though we will get there. One truth. You are the biggest risk to your own money. It is not the market, and not inflation, and not the Fed. It is you. I know that sounds harsh. Let me prove it with the data, because this is not an opinion. There is a research firm called Dalbar. It has tracked real investor behavior for more than 30 years, not what the market did, what people actually earned after their own buying and selling. The gap between those two things is the most expensive number in personal finance, and almost nobody has heard of it. In their most recent report covering 2024, the S&P 500 returned about 25%, a tremendous year. The average stock investor earned about 16.5%. In a single great year, the typical investor left roughly a third of the gains on the table, not because the market failed, because they moved their money at the wrong moments. They pulled out when it got scary and climbed back in after the rally had already left without them. And it is not just 1 year. Look at the last 20 years. The S&P 500 returned about 10.3% a year. The average stock investor earned about 9.2%. That gap sounds tiny. It is not. Put real money on it. $100,000 left in the market for 20 years grows to about 717,000. That same 100,000, run by the average investor's own decisions, grew to about 586,000 instead. The difference is roughly $131,000 gone. Not lost to a crash, not lost to fees, lost to the person holding the account, lost to hands that could not stay still. That is the one. You are the variable. And once you accept that the enemy is not out there but in the mirror, the whole thing changes. You cannot control the market, but you can control whether you touch the account. So the one is a rule about your own hands. Automate everything. Then there is nothing to decide when you are scared. Set the contributions and hide the password if you have to. The best investors are not the smartest. They are the ones who found a way to leave it alone. There is a famous study of the best performing accounts at a big brokerage. When they looked at who did best, a pattern showed up that the firm did not expect. The top performers were the people who had forgotten they had an account at all. They never logged in, they never tinkered. No clever moves at clever moments, just years of being left completely alone. Their edge was not intelligence, it was absence. They were not in the account to panic, so they never did. That is the strange lesson hiding inside the behavior gap. In most of life, effort improves the result. You work harder, you get more. Investing punishes that instinct. The more you touch it, the worse you tend to do. Most of your touches will be emotional, and emotional timing is worse than a coin flip. Dalbar found investors guess market direction wrong a majority of the time. Doing less is not laziness here. Doing less is the strategy. Now, I promised you the other one, the small practical one, because it turns your discipline into a much bigger number. Every year, raise your contribution by 1% of your income. Just one. When you get a raise, before the lifestyle creeps in, nudge the savings up a single point. It is small enough that you will barely feel it in your paycheck. Watch what that tiny habit does. Take someone earning $80,000 who saves 5% in an account earning about 10%. Left flat. After 20 years, they have about $253,000. Now raise that contribution by 1 point a year, capping at 15%. After 20 years, they have about $526,000 instead. The same person, the same salary, the same market. More than double the result, from a change so small it never once hurt. And that is only 20 years. Stretch it across a full career. A flat saver ends near 2.1 million. The 1 point a year saver ends above 4.6 million. The difference is not talent. It is a single percent added quietly every year while everyone else let their raises turn into bigger cars. Here is why this one works so well, and it has nothing to do with the market. It works because of timing. The moment to catch a raise is before you have gotten used to it. A raise you have never spent is painless to save. You never felt it, so you never miss it. Wait 6 months and it is gone, absorbed into a nicer apartment and a bigger grocery bill, and now saving it feels like a cut. The 1% rule just intercepts the money on its way in before your lifestyle can claim it. And notice the quiet enemy it defeats. Standing still feels safe. You are saving, the account is growing, nothing is wrong. But inflation is not standing still, and neither is the cost of the life around you. A contribution that felt generous at 30 is quietly shrinking in real terms every year you leave it flat. The 1% is how you keep pace with a world that never stops getting more expensive. Without it, even a disciplined saver slowly falls behind while feeling perfectly responsible. So put the 3 numbers together because they are not a list, they are one machine. The 100 keeps you from selling by telling you the storms are normal and there will be about 100 of them. The 7 keeps you from quitting. It shows you the reward is real but backloaded, and the first 7 years are the price of the ticket. And the 1 keeps you from drifting and from standing still. It reminds you that your own hands are the real risk, and that a single extra percent a year added on purpose quietly doubles the ending. Every one of those 3 is a defense against a specific way people wreck themselves. Panic, boredom, and the slow leak of never adjusting. That is the whole rule. 100, 7, 1. And they need each other. The 100 without the 7 is a trap. You held on tight to an account you quit too soon. The 7 without the 100 fails too. You meant to stay, but the first real crash shook you loose. And both of those without the 1 means you did everything right on a contribution that inflation slowly hollowed out. Miss any one number, and the other 2 spring a leak. Together they close all 3 holes at once. Now, let me be honest about the limits. The way I always try to be, none of this promises you a number. The 7% I used is a long-run historical average, not a guarantee, and your actual path will be lumpier than any clean chart. Some decades run hot and some run cold, and you do not get to pick which one you retire into. I am not selling you inevitability, and the rule does not fix the savings problem. If you are not putting money in, no amount of patience compounds zero into something. The 107 and 1 rule is for people who are actually investing and keep sabotaging the part that was already working. It is a behavior fix, not a magic number. There is also a real limit on the 1% step. At some point you hit what you can actually afford. Pushing past that into debt or misery is not discipline. It is just a different mistake. Raise it until it pinches, then hold. The goal is a habit you keep for decades, not a heroic year you burn out on. But inside those limits, the rule holds up because it is not really about the market at all. Every number in it is aimed at you. It targets the moment you want to sell, the year you want to quit, and the raise you want to spend. Compounding was never the hard part. Compounding is just math, and math does not get tired or scared. You do. So here's what I want you to actually do this week, and it takes about 10 minutes. Open your account and look at when you started, so you know where you are on the road to 7 years. Then set your contributions to rise automatically by 1% on your next raise if your plan allows it. That way you never have to make the choice again. And write one sentence somewhere, you will see it the next time the market falls. It should say, "This is one of the 100, and I do nothing." That is it. You are not trying to be brilliant. You are trying to be the person who was still holding when the slow part finally ended. Because it does end. The flat years are not the story. They are the setup. And the people who get to the good part are almost never the smartest ones in the room. They are just the ones who refuse to touch the thing while it is quietly getting ready to work. Tell me in the comments which of the 3 numbers is your weak spot, the panic, the boredom, or the standing still. Be honest, because naming it is how you start to beat it. I read every comment and I reply to as many as I can. And if you want the next video, hit subscribe. It is the one on exactly what to do with your money during a crash, which is where the 100 gets tested for real. I'll see you in the next one.